Just wanted this morning to spend a bit of time previewing our sector, the consumer discretionary sector, heading into August reporting season. You as a network know the stocks we cover. This is a scatter chart here that really just explains the fact that the wide divergence in PEs and valuations continues. Obviously, to the right there, we've got the growth basket, the stocks that have structural growth options. The basket to the left, the very cheap, worried about growth and some macro issues playing out. And then you've got a really mature kind of basket in the middle there that have actually lifted off their lows in terms of PE ratings because the market's just happier to apply a higher multiple, not necessarily because earnings have caught up just yet, but a wide divergence, and that's always the case and will continue to be. Just in terms of our reporting season playbook, if you like, looking firstly at the result beats, you can see there are three clear stocks. We're looking at AP Eagers, Baby Bunting and Accent Group. Result miss candidates, Domino's, we've explained, I think, at depth why we think that might miss again. Most importantly, reporting season is always about the outlook commentary, those that can give formal guidance and even those that can just point to the drivers that will make for another strong FY20 growth year. And there we call out Bapcor, Baby Bunting, IDP Education, Noni-B and Lovisa. The ones where we think it'd probably be a mistake to give guidance, just given the volatility going on in their markets, and therefore we will require more patience to see how FY20 plays out. That's all the fallen angels there, Adairs, Apollo, Motorcycle Holdings and National Tyre. There will be a time, but potentially more patience will be required. And lastly, capital management. I mean, it's not that frequent in the retail sector. There's always something to invest in to bulletproof yourself. But I do think Domino's Pizza, with a rock-solid balance sheet and a strong cash-generative business that is a franchise business, could well launch another buyback. If we just start with the macro first, and we're in a bit of a black box moment because every stock's is in blackout, and the last 6 weeks of trading updates are so pivotal to how these stocks will trade. So we spent a lot of time talking to unlisted peers over the years, and particularly in the last couple of weeks. It's all pretty consistent. They saw the post-election trade kind of bounce back for a couple of weeks, and that coincided with a couple of big cyber events. And then it's really gotten tough again, particularly in the last couple of weeks. But that's retail. A few categories to call out where it has been a bit better than others. We're hearing good things about footwear and good things about jewellery. We're hearing that apparel in some markets has been tough. It's always pretty tough. And also hardware particularly tough in the last couple of months as well. If you just look at the PE for the sector at the moment, it has really bounced off the lows, so is the market, still underperforming, obviously, the 200 by some margin. But we are up to around 15 times here now for the consumer discretionary average, so trading at the top end of that band. That's lifted quite heavily from the start of this year as people have covered underweight positions and really gotten a bit more excited about potentially the housing market bottoming out, a little bit of fiscal stimulus flowing through, lower interest rates, etc. So, I would say a majority of that lift off the bottom has been driven by the big guys like JB Hi-Fi, Harvey Norman, Super Retail Group. And again, not because we're seeing any earnings re-rating coming through, it's all just PE, and the market being, I guess investors being in a market where they're willing to pay 12 times for these as opposed to 10 times, and also 6-7% yields are being bid in this kind of market as well. If we just look back in 2008-09 post-GFC when Prime Minister Kevin Rudd handed out all those big incentive or those big cash checks, the market nearly doubled the retail sector. I just would caution, though, back then that these businesses were a lot more immature back then. They were in full store rollout mode. But I just wanted to show that fiscal stimulus can work, and our economy wasn't great back then. So we've got some tax incentives coming through really from now until the end of this year, whenever people lodge their tax returns. So it can be very beneficial, even just from a PE re-rating perspective. But hopefully we do see a little bit of earnings follow through from this spend. And all the unlisted guys we've talked to are quite hopeful in that respect. Just looking at store rollout profiles that I mentioned before, we are in a much more mature market. All these big guys really don't have much left, and that's being reflected in PEs. But the guys at the top there, your Lovisas, your Domino's, your Beacons and your Baby Bunting still have quite a runway for store rollout growth. So you're at least before you even start the year banking some kind of footprint growth, which is helpful. Also really important to know, as I said, once you get to reporting season, these stocks really only trade on a 6-week like-for-like sales trading update, which is, incredibly short term, but it's what happens. So if you can just look there, the ones I've shaded in red are the stocks that are actually cycling quite a strong base coming into their trading updates, and conversely, the ones shaded green. So, the Adairs, the Accent Groups, Bapcor, Baby Bunting, Domino's, 90B and Super Retail all cycling pretty strong bases. And oppositely, you've got Beacon, JB Hi-Fi, Lovisa and Michael Hill all trading pretty weak base, just to keep that in mind on the very short-term view. So we're going to head into a few preferred stock picks now. I'll start with AP Eagers, and I just wanted to give a bit of context there around historical national car sales. So we are now in about 14, 15 months into a down market for national car sales, as you can see by that top chart and the bottom. That second chart shows how closely correlated car sales are with house prices. And I think we can all read the paper. We've seen some bottoming out there, maybe even some potential of some increase there, which might be helpful. Not calling out that we've definitely seen the bottom or it's going to get easy really quickly. But I would just say we've looked back at the last 5 down markets in car sales, and they typically average around 14, 15 months, which is where we are at the moment. And maybe that's not the best forward indicator, but it's something at least we can hold on to. So just on AP, because we've spoken a lot about this stock, and I completely understand it's had a strong rally recently. So the question I get asked a lot, and we did a sector note on this trying to put the two businesses together. So on a very base case assumption, looking at the, maybe $27 million of synergies and not much operating kind of leverage in the business, I think the combined business is trading on around 17 times here. And if I'm on a more bullish case scenario, so those synergies, but also assuming they can increase AHG's margins, not quite to their own, but somewhere in the middle, I think the stock's trading on a merged entity basis about 14 times on a bull case scenario. Just one thing to call out, we do think it'll eventually go into the ASX 200, maybe mid next year. It'll need 6 months of potentially trading. The passive money will follow that. And just one other thing, there's a potential for this balance sheet to be quite undergeared in time. They paid scrip for AHG. The OEMs will require them to sell a couple of businesses. They've sold some property recently. Ultimately, that will have to be invested in the auto mall. But for now, it's very helpful. And if they can remove, this cold logistics business, which I'm sure that the company's focused on, this could be a quite undergeared balance sheet, in which case capital management may be on the agenda. Just moving on to Lovisa, I'll start here on the US. So we do a lot of digging around, websites, HR websites in the US. So I know that's small, but I'll send this through later. But we're of the view that by the result, they'll have about 20 stores on the ground in the US. So they're only 6 months in from their pilot phase. So that's pretty startling momentum. And we can also see them advertising for staff in another 12 odd locations. So if you're advertising for store staff, you're probably only 6 weeks away from opening the store. So already kind of 6 weeks into the financial year, they could have 12 stores on the ground, which is nearly half my full year rollout. And this company has a very big second quarter skew to its rollout. So I guess what I'm saying is my forecasts are probably going to be light, and there's plenty of momentum here. If you look at it on a state basis, they're now in California, Texas, Florida, Illinois, and Michigan. I don't think it'll be long before they go above, the Sun Belt there, and then potentially straight into Canada. And Shane Fauci has said as much. So if we look at the result, I'm only looking for an inline result. Please don't be expecting anything different. Rolling out in 11, 12 countries requires a big cost step up, and that will impact them this year, and everyone's got that in their numbers. We are looking for modestly positive like-for-like sales in the second half, as opposed to negative in the first half. This company never gives outlook commentary or formal guidance. That's great. That's the understated way of this management team, and we like it. I am always cautious of some analysts getting a little bit carried away in the upside here and the store rollout and things like that. Like they think a base case is 60, whereas I prefer to let the company beat me along the way. So that needs to be kept in context when you're trading on 30 times. I just put in the box there, though, just so you can kind of have a feeling what a more bullish case situation would look like. If I put 50 stores per annum in the US into my numbers, and I also think maybe that their cost of doing business can get back to historical levels. levels, which is the aim of the company, but I forecast nothing like it, then you can see how they'll be beating my numbers by 20 to 25% per annum, maybe from FY21 onwards. So, you can quickly, this thing isn't as expensive as you think. It is fashion-led. There are risks with that. There are risks around gross margin, comps. It'll be volatile. But look, there's just nothing quite like it in our coverage, and so happy to stick with it. On to Baby Bunting. It's not cheap, again, but as I say, the duration and the quantum of growth is hard to find. We're hoping that they can beat consensus expectations, which should probably see them grow at about 40% this year. In terms of their outlook commentary, we're again at another 30% next year, which seems a bit crazy, but at least half of that, 15 to 20%, is coming from the store rollout because they are very young, putting 6 stores on the ground. That gets you your footprint growth. We're forecasting just 3% comps, a little bit of gross margin expansion, but mostly some operating cost leverage as they come out of that catch-up investment phase. So there's a little bit of risk around that, whether they find something else to invest in. But if they do, I'm sure it's for the right reasons. But I actually think if they can beat this year, then that step up into next year won't be as pronounced. We've spent a lot of time catching up with suppliers in the last few weeks, and the feedback, they're screaming from the rooftops because it's not in their best interest to have one man standing, and that's the way it's going. So recently, Nuna, I'm sure Timmy knows, the big car seat supplier, they basically cut out their whole middleman wholesale distribution channel in Australia straight to Baby Bunting, and they are now the sole distributor. And that could be the way this whole business goes, that you get rid of all the middlemen, and there's a big wholesale margin there on offer for Baby Bunting as well. So very happy to stick with the growth there. Bapcor, this is a wonderful stock. It hasn't done much in the last 12 months. In fact, it's gone down as people are a little bit concerned around their guidance. They've reiterated that 3 times now in the last 3 months, so let's assume they should hit that. In terms of their outlook commentary, look, I think they'll guide to 7-8% organic growth, and that's not bad. It's been a tougher 12 months, but there are actually some signs of the competitive intensity from the likes of Repco GPC starting to ease. So if they can point to that, give some firm guidance because it is a defensive business, then I actually think this stock can still do some work. You can see on that chart, they still traded a decent premium to their offshore peers. And that's why I think, the valuation plus the fact that their private label penetration is so much lower than the rest of the world makes them an easy M&A target, in my view, for one of these US guys to come in, pump out the private label, double it quite quickly, and get some real synergies in that business. You can't always rely on M&A, of course, but to me, that's one that makes sense. Just about looking at the other big guys, so JB's, Supers, and Domino's. JB's, it's had a big rally this year. I'm angry at myself I didn't get on with that, but it's a pretty mature retailer now. The growth's about 3% here or there. Store rollout's done, so this is now a leader in its field. It's growing modestly. It's paying out a nice yield. It's paying out a lot, and it's a big payout ratio, and therefore there's a place for that in some portfolios. This is not a structurally challenged business in my view. They will give sales guidance next year. They're cycling a low base in their trading update. So if you're there, I just hang on as a decent place to be, but I'm not chasing it at these levels. Super retail, I think, has been where all the instos have been hiding in a nice liquid place. So if there's any hiccup there, I think it's going to get dealt with quite harshly. They've got some strong comps to cycle. They've had a huge amount of senior leadership transition, and I think that actually might impact them over the medium term. But look, 12 times 5.5% yield, you can see why they're hiding there. But for me, again, it's just a little bit too ritzy. Domino's is the most interesting one here, and again, it's been really tempting. I do think this result is going to miss, but the whole world is expecting that, so that's where it's interesting. I've just been doing a little bit of work. The ACCC came out recently and said that they're asking for submissions, but have basically said there's a world where they think individual groups of franchisees can bargain directly with suppliers and against maybe the franchisor. Or now, if that comes to pass and all the power is in the quantum of these franchisees banding together, that could be a decent headwind for a franchisor like Domino's, who does make a fair chunk of profit out of supplying food, supplying ovens, etc. there. So we've just got to watch this space. There's nothing that's quite happened there yet. But again, great cash flow generation. I think there's a good chance they launch a big buyback, but still a few headwinds I'm just trying to get my head around. Lastly, so some of these fallen angels which have plagued us this year, Firstly, Adairs, they had that recent downgrade, so we're not expecting any result surprises. FY20 guidance, I'm actually sitting down 8% next year, or down 7.6%. The market's up a couple of percent. Look, I think they'll struggle to give guidance anything more than probably flat next year. Comps have gone flat. We've got gross margin headwinds across the board, and that CODB won't get fixed until they fix the supply chain, and that's 18 months away. They'll come out and explain that and their investment in the supply chain, but it's still a bit away. Apollo, hopefully they can hit that second downgrade. I would not want any of these bottom three stocks to provide any kind of guidance. It's just too volatile out there, and that's a rod for your own back. And I think that would be a promising thing. But look, I think I'm expecting rental forward bookings to have slowed, given the global kind of some of the macro headwinds out there. And it just remains a little bit difficult to see that earnings visibility. And we also have no CFO as yet. So just sitting on the sidelines for now. Motos is interesting. There was a good article in the Australian yesterday. And, I definitely don't expect any result surprises, don't expect any outlook commentary. But it feels like we're somewhere near the bottom, but we don't know exactly when that point's going to be to launch. So I think we've got time on our side, given this balance sheet, to actually see the volumes really improve. And it feels to me like the industry is still in decline, better than it was, but still in decline. And tyres, look, I think being a tyre wholesaler wouldn't be the most amazing place to be, and easy to sell tyres at the moment. We saw Cooper's result last night was pretty tough in its international segment. Again, expecting an inline result, not expecting forward guidance. The best thing this company could be doing, trading below asset backing, is doing a buyback. There's no promise of that, but I'm of the firm opinion that that's where the best investment could be made, given you can't buy any other business for below their asset backing, I can imagine. So patience required with all those four too. And I think, they won't give guidance, so it's going to take, more patience to believe in the outlook.